Hello everybody, this is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, and one of the founding partners of the Dividend Kings marketplace service on Seeking Alpha. We are clearly going through scary times today, and this article in today's Wall Street Journal titled Stocks Extend Drop as Anxiety About Virus Returns really kind of showcased the mood of the marketplace today and how, volatile and how scary. The market's been going up and down like a seesaw here in the last couple of days, and heard about the virus. But what I wanted to do with today's article is kind of put the valuation of the markets and what's actually been happening into maybe a clearer perspective and hopefully a longer term perspective. So I'm going to start here with a graph of the S&P 500, and I'm looking at earnings and dividends here. The orange line on the graph as it currently sits represents a PE ratio of 15, which is kind of a normal valuation reference of the market. And then what I'd like to do next, I'd like to add monthly closing stock prices to this graph to kind of put today's market valuation into a little clearer perspective. And then next, I'd like to add the normal multiple or normal valuation that the market has most commonly applied to itself, I guess you would say, over this historical time frame going back to the beginning of calendar year 2000. Now, this includes both the recession of 2001 as well as what I call the Great Recession of 2008-2009. Now, I want to clarify some things. If you look at the beginning, as I pointed out in the written portion, the blended PE ratio of the market was very high, over 28, as we were coming into the recession of 2001. And consequently, if I carry that out to the end of 2009 or, the beginning of 2010, which is what I showed in the written portion, you can see that we had what has been referred to as the lost decade. The S&P 500 actually generated a negative 1.1% rate of return, which included dividends. That was a 24% negative growth. In other words, the market went from 1469 in January 31st, 2000 to 1115 by the end of January 2010. That's a 24% drop. However, we add in dividends, which were averaged about $1,400 over that time frame, and we ended up with a $10,000 investment in the market would have actually been worth about $9,000 counting market loss plus dividend income. That's a minus 1.1% rate of return. But what I hope you see from this picture is the fact that if I look at the operating earnings of the market, it really didn't do that badly, considering the fact that, we were coming out of the greatest recession in history. The earnings of the market was about $56 a share, if you will, of the S&P on 2000. And then by the end of 2009, 2010, earnings had actually grown to about $61. And then, we had a really strong recovery in 2010 where earnings of the S&P went to $85. So when you look at it, the operating results weren't so bad. We also had very good dividends during this period of time in the market. You can see $10.27 rising all the way to $27.66 before they ultimately dropped it to $22 and then started rising again, because that was again during the Great Recession. But the point is, the operating results of the average company in the market, or the average of the 500 companies in the S&P 500, was actually better than their actual performance, and that was really attributed to this very high valuation that we saw at this time frame. And what happened was the market ended up over the next couple of years kind of reverting back to a more rational valuation level. And then, of course, when we came into the throes of the Great Recession, the market became undervalued. And then it was fairly valued for several years. But then coming out of 2013, we started to see valuations get pretty high again. And so we were on the high end of valuation. And then today we're sitting here at what I would call not near as high, a blended PE of 19, as I mentioned in the written portion, as we were back here. But, I can find that time frame, and you can see that, if I can find that PE of about 19, this is about as close as I can get, that would still have led to a rather anemic market performance over the next several years of averaging about 4%. Now, having said that, as we came out of the recession and earnings began to grow again, and I'm just picking an arbitrary time here, we've seen very, very strong, significantly above average market returns post the Great Recession. If I go from the actual bottom of the Great Recession, which obviously we can only see in hindsight, and go to where it ended up yesterday, the market has been generating returns, including dividends, of over 15% a year. That's very, very attractive. Now, there's another way to look at this, because I do want to look at the PE ratio of the market versus interest rates. And we're down now, you can see, as interest rates have dropped, the multiple of the market has increased somewhat. So part of today's valuation could be attributed to or even justified by today's low interest rate environment. The yield on a 10-year Treasury, as we saw in my opening slide here, is below 1%. And you've got about a 1.9% yield on the S&P 500. As a result, we can get better yields from stocks today than we can a lot of high-quality bonds. So the market itself is actually moderately overvalued, but as I've often said, it's a market of stocks, not a stock market. So I'm going to move into portfolios here, and I'm going to take a look at the S&P 500 as an aggregate here and utilize the portfolio function of fast graphs so that I can look at the relative valuations of many of the individual stocks that actually comprise the market. And there are two columns here that I really would like to focus everybody's attention on. Those columns would be the PE ratio of the individual constituents making up the market. I've got them ranked here from highest to lowest. And then the earnings yield, which is the inverse of the PE ratio, because I believe that's critically important. I like to see an earnings yield of about 6.5% to 7%, which is consistent with a 15 PE ratio, which is historically what the market has delivered on stocks, or how the market has valued stocks over the long run. So when I look at that, as I kind of scroll through this list, you can see we've got earnings yields of under 1% here on many of these stocks, but look how far deep I'm going into the S&P 500 here, and I'm still seeing earning yields of only 3% or so, and I really go in here deeper and deeper, and I'm still seeing PEs of 23, 24, 25, and lower earnings yields, 4% earnings yields. As I keep going through this list, I'm starting to get a little closer now. I'm closer to that 17 normal PE that we've seen, maybe adjusted for interest rates, where I'm starting to get some 5.5% and 6% earnings yields. But then as I go through this list even deeper, I got to go pretty deep in this list before I start getting a 6.5-ish type earnings yield. And so to put that into perspective, let's take a look at some individual constituents. For example, Target would be a good one to look at very quickly here. You can see that Target has had kind of a really interesting recent history. We had a period of time where we see this constant overvaluation moving back into alignment with a 15 PE, and then we saw the Target get pretty expensive coming into 2020, and now we've had a pretty significant correction. And although it's not quite as cheap as I would like to see it, it's obviously gotten to the point where we're getting an earnings yield of just under 6% and a blended PE of 16.6%. So, that doesn't look too bad when we start looking at Target. But if I go back up the list here and start looking at some higher valued, what we'll call S&P 500 stocks, one that might be pretty interesting to look at would be to look at the S&P Global, the company that actually keeps track of the index, and also the Dividend Aristocrats, which I'll cover here in a moment. And if I look at the current valuation of the S&P Global, we can see that the blended PE is over 30. The earnings yield is 3%. And I want you to look at this history here, because you can see that the market has commonly valued this stock at a 20 multiple, even through the 2001 recession, and then coming into the Great Recession of 2008, where it corrected and got very inexpensive. Then it kind of moved back into that. But even considering the normal high multiple that the market has put on S&P Global, we can see that that valuation has really gotten dramatically ahead of itself currently. So we're seeing all types of valuation levels when we look at these different stocks and different constituents that make up this S&P 500. We've got names like Ecolabs, another interesting stock that the market has always applied a very high multiple to, and you can see that the market's wanted to value this at something around 25 to 27 times earnings. The blue line on this graph is a PE of 27. You can see it's gotten even, significantly higher than that. And then on the other hand, you can look at other constituents, names like 3M, for example, that had been very, very high in recent times, and then we've had a correction. And so, look how different all these stocks are. So, this idea of thinking about stocks in the general sense is really a bad idea, in my opinion. You can see that 3M is getting down to a blended PE of 17. That's within, the normal multiple of the market. and an earnings yield of 5.8 with a dividend yield of 3.8. So for the first time in quite a few years, 3M has actually become reasonably attractive. The bottom line is it's a market of stocks, not a stock market. So let's move on, because one of the other areas I wanted to cover was the Dividend Aristocrats list, because there's a lot of people investing for income today, and that's a select group of stocks that have become very, very interesting from the standpoint of valuation. Interest rates are low, as I mentioned in the written portion, and so if I go into the S&P Dividend Aristocrats here, there's 64 companies on this list, and if I organize these by earnings yield, highest to lowest or lowest to highest, you start seeing that there are some really high valuations. Now, Realty Income is a REIT, so when you're looking at Realty Income, you would look at price to cash flow. But here's your Echo Labs trading at this very high PE. There's your S&P Global trading at a very high PE. Here would be McCormick, which is the spice company. Let's take a quick look at that, because this is a Dividend Aristocrat, and you'll see that the valuation of this stock has gotten really high. I want you to notice that, it's become difficult for it to continuing to advance here, but this is a stock that the market has applied high multiples for historically. It didn't get down into this 15 multiple other than the Great Recession, but even given this what I'll call normal high valuation, you can see that this stock is trading at really an excessive valuation today. Now, when I look at this, I want to do earnings yield here from lowest to highest. You can see, just like I did earlier with the S&P 500, that I have to go pretty deep into this list of Dividend Aristocrats before I start getting attractively yielding companies. Now, if I take a look, for example, at General Dynamics, this is another example of a company that was significantly overvalued in recent times that has now come into actually undervaluation territory. But I also want you to notice that, I consider the risk of overvaluation, I consider that to be much more troublesome than looking at low valuations, because low valuations represent long-term opportunity and high valuations, in contrast, represent a great deal of risk. But there are some stocks in this list that have gotten very inexpensive here recently that, have the potential to give you long-term coverage. I recently wrote about Cardinal Health. You happen to notice the health stocks did really, really well a couple of days ago as a result of the elections, the Democratic Party, and, some of the strong showing that we saw where we're getting rid of some of these threats to universal health care, perhaps. So people started to look at some of these health insurers, and now, of course, Cardinal Health is a medical distributor. But you can see this stock is significantly undervalued, even though it has a great long-term dividend record. So it is a market of stocks and not a stock market. There are a lot of stocks out there that are inexpensive today, in contrast to a lot of stocks that are also very expensive today. We still have financial stocks like Aflac, Prudential, and others that are suffering from what I would consider to be a reset evaluation. These stocks were trading at pretty high values prior to the financial debacle, but then subsequent to the financial debacle, you'll notice that the market has been applying about 10 multiples to some of these financials. So, there's all types of opportunities still available in the market, but they're relatively rare considering just how high the overall market is. Anyway, my idea here was just to give you a better perspective on what valuations look like in light of all of the volatility we've seen as a result of the coronavirus. The coronavirus, of course, is very real, but my point is that you need to recognize it is a market of stocks and not a stock market. And, if you're willing to look hard enough, you can find good value in any market, including the bear market we've had now. But perhaps the most important point I'm trying to address here is, even in spite of all the volatility we've seen recently, stocks are still pretty extremely overvalued, and you should be considering that as you're looking and navigating through these troubled times here. Anyway, this has been Chuck Harville saying thanks for watching. I hope you enjoyed this.